Happy Wednesday out there, Team 42. It's your skipper here, Darius Dale, to present our macro minute for Wednesday, May 8th, 2024. As always, we'll start with the executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions, as well as what to specifically do about them in your portfolio, you need to be a client of 42 Macro. So today's key macro event is our green shoots globally theme continues to dominate global equity market dispersion. So the nuance there is Sweden's Riksbank cut its benchmark policy rate for the first time in 8 years. The move follows a rate cut by the Swiss National Bank in March. Elsewhere, we improved our positioning model by adding the National Association of Active Investment Managers Net Equity Exposure Survey to our compendium of short-term indicators, while reclassifying S&P 500 3-month realized volatility and 3-month implied correlations to our compendium of medium-term indicators. In terms of market implications, with the ECB set to cut at its June 6th meeting, Europe is leading the U.S. in terms of following through on dovish policy guidance. That plus our green shoots globally theme has contributed to an outperformance of European equities. The Stoxx 600 index is up 2% week to date, up 1% month over month, and up 6% on a trailing 3-month basis versus the S&P 500 up only 1% week to date, down 1% month over month, and up only 4% on a trailing 3-month basis. Lastly, the net result of the aforementioned changes is our positioning model is now signaling blank risk of a cross-asset correction over the short term and blank risk of a crash over the medium term. And those two blanks are, you have to be 42 macro client to identify exactly the level of risk that we're identifying in both of those durations. Just as a reminder, anything that helps you make and save money in asset markets is behind our paywall. Anything that helps you think about how to make and save money in asset markets in terms of my tone, what we're talking about on podcasts, about growth, inflation, and policy perspective, do what you want with that information. At the end of the day, we don't use that information to make and save money in asset markets. We use our sophisticated risk management systems to help our clients make and save money in asset markets. And that obviously positioning model is one of those core models. So, all right, cool. So transitioning to our 42 macro dashboard, as always, we'll wrap up with the question from our community. This one's titled, how do you factor in Fed actions? So it says, greetings, Darius. Thanks for what you do for others. A quick question. How do immediate actions, for example, the Fed making rate cuts, factor through your predictive models? Please shine some light on the magic behind the curtain. Appreciate your service. So in terms of things like Fed action, so if you think about our process, there's sort of 3 elements of our process that we're using to help investors stay on the right side of market risk. The most important element of that process is helping investors identify and position for the market regime. The market regime is the dominant driver of asset markets in terms of the absolute returns that you see across asset markets and dispersion within asset markets at the factor perspective. We use our global macro risk matrix to identify the macro regime, and then we use our macro weather model to help us gain confidence and or build or erode confidence in sustainability of the current regime. And then we use our qualitative research process to help us build and erode confidence in the sustainability of the regime, and also to help us proactively prepare for what regime change might look like and over what time horizon. And so things like the Fed actions, anything when we talk about growth, when we talk about inflation, when we talk about policy, it's always in that third bucket of trying to identify and help investors proactively prepare for regime change. And if we don't see regime change on the horizon, then we're helping them proactively prepare for the sustainability of the market regime. And so at the end of the day, if you just consistently do that 3-step process over and over and over and over and over, you don't have to know where growth is going to be a year from now. You don't have to know where inflation is going to be a year from now. You don't have to know where policy is going to be a year from now. You don't have to predict anything at all in terms of making and saving money in asset markets. In my opinion, the predictions are what get people in trouble in terms of the positions that they put on that are associated with those predictions. When you think about you try to use driving a car as an analogy, if you took I don't know, for those of you maybe old enough to remember this, if you printed out a MapQuest map and just held the MapQuest map right in front of your face as you were driving, you're probably not going to arrive at your destination. However, if you're in a newer car with, your Apple CarPlay here, and it's got your Google Maps and all the traffic and everything, and you can probably arrive at your destination if you are also looking out the windshield and also have your other eye on the technology that is the new map feature. So, our process is more akin to looking through the windshield and at the map versus what most people are doing, which is I printed out my map. I know what my predictions are, and I'm going to stick my map right in front of my face and just start driving my car and not look out the windshield at changing market variables and changing economic variables, which is something that I think retail investors do quite poorly. Institutional investors do pretty well, generally speaking. All right, so wrapping up. Thanks again for joining us. As always, we'll catch you back here tomorrow. Best of luck out there. And for those of you who are clients and or about to become clients, we'll have our Pro to Pro live discussion this afternoon with our friend Tracy Schuchard, who's an expert in the energy and commodity space. Got a lot of great questions for her, so tune in for that. Catch you back here tomorrow. Cheers.